let's start with what the 10-year may be telling us or not telling us about the economy overall, particularly where inflation is and where the economic growth is.
Look, David, I've been predicting that rates would rise for quite some time. The 10 years got three pieces. It depends upon expected inflation, it depends upon the real interest rate, and it depends upon the term premium of the amount that the 10-year rate is more than expected future short rates. If I take those three pieces, inflation may come down, but I think most people would be quite surprised if it was as low steadily as 2% over the next decade. So let's assume that inflation averages 2.5%. I think that's conservative. We don't know what's going to happen to the real interest rate, but we know that budget deficits look to be very large. Perhaps the budget deficit, according to CBO, will get to 7% by the end of the decade. And I think on more realistic assumptions that assume that some of the Trump tax cuts are preserved, assume that we have to expand national security spending, and make realistic assumptions about the servicing of the debt. The CBO thinks it's going to cost 2.3% for short-term Treasury bills. I think you put all of that together, and you're looking at a real interest rate of 1.5% to 2%. And then you look at the fact that the Fed is selling down its portfolio. You look at the fact that the financial regulators trying to avoid SVB situations are making it harder for banks and other financial institutions to buy long-term bonds, and term premiums usually are 75 to 100 basis points. So if you take 2.5 and for inflation, you take 1.5, which isn't especially aggressive for real rates, and you take 75 basis points, which is lower than history, for term premiums, you're looking at 475 on the 10-year, and it obviously could end up being higher than that. So nobody knows, but it seems to me we're in a very different era than the era we were in the aftermath of the financial crisis. We're in an era where employers are having trouble finding workers. We're in an era where there isn't growing competitive pressure from globalization. If anything, the opposite. You're in an era where there's growing empowerment of labor, as suggested by what's happening in the automobile industry now. So I kind of would guess that these higher long-term rates are with us to stay. And if I had to bet, I think I'd bet that they're more likely to go higher than to go lower. And I think in general, markets are going to have to adapt to that reality.